In this video, guys, we're going to look at doubling down to recover a trade. Stay tuned. Hey traders, a very warm welcome to you. Thank you for joining me. All right, so doubling down to recover a trade, what does it all mean? What it's all about? So doubling down basically means that you are buying as the market goes against you in order to improve your average order entry price. Otherwise, sometimes known as a martingale type system, you're basically increasing your risk, but you're reducing your entry price or lowering your entry price. Yeah, I'm gritting my teeth a little bit here, but bear with me on this one. Okay, so, and those of you who are on the channel for a long time are going to probably smile as I'm talking about this. So what have we got? We basically got buying 10 here at 107.50, for example. So there's our first entry. Right, the market goes against us by about 50 pips. Let's say this was an FX pair, could be anything, or 50 cents. And we buy another 10 at 107, right? So now, what's happened to us? We've actually doubled our risk from 10 to 20. But what we've also done is we've lowered our break-even entry price from 107.50 to 107.25. So what does that mean? It means that we have played this game. And as you might guess, this is a very, very dangerous game. Why? Because yes, we have brought our average entry down, and that's great, but we've doubled our risk. So if we assume that we're obviously wrong when we bought this, our timing was wrong. So we are hoping that our timing is miraculously right now at this 107. It could be, and if it pops up to 107.50, at 107.25, then great. You know, if we popped up to 107.50, if we hadn't done that ad, we'd be at break even. But actually, we've made, you know, a nice 25 pips here. So we've made good money because we've actually made, 50 pips from our 10 entry. We've made nothing from our 50. So it's worked out okay. Now, the argument for this, or people who argue for this, is that markets never move in one direction. And they're right most of the time, right? Most of the time, markets are going to do this. You know, they're going to move down a little bit, they're going to move up. And if you've got deep enough pockets, this will keep you in the game for a long period of time. I've seen lots of these copy trade type people who operate this kind of thing, and they'll add more. They'll add another batch, another batch, another batch. And that's fine until you get to, because you're lowering your entry price, your chances of coming out with a profit are now significantly higher. You're improving them, increasing them every time you do that. However, the hidden part of it, which is not really hidden, is you've now just increased your risk fourfold by doing that. You've increased your risk dramatically. So yeah, you could say, well, I'm going to come out with a profit, but how dangerous is that now? What happens now if that thing just suddenly spits through the floor when you've got your final martingale add-on? You've added all this position, you're in 10 times your position size, you've got 100 lots, or you've got £100 a point or whatever it is, and all of a sudden this thing just suddenly collapses. You are in your worst position with your biggest size, which is exactly the opposite of what you want to be. It takes one of these to go wrong and completely wipe you out of the game. Completely wipe you out, not even just hammer your account, but wipe out your account. And so this is dangerous. However, if you use this under certain circumstances, you can use the power of this to your advantage. Now bear with me, because adding at 107, buying 107.50 is fine. Buying at 107, if you're just doing it to reduce your entry price purely because you're wrong on the first one, that's no good. If you'd, however, planned the trade and said to yourself, right, this area here is a zone I want to buy in. I'm going to buy my first batch at 107.50 and I'm going to buy my last batch at 107 and I'm going to have a stop on the whole lot at 106.50 or whatever it may be. That then becomes a very reasonable trading strategy because you're basically saying to yourself, you know what, I don't think I'm that good at picking the turn. I think this area is the turn, so I'm going to spread my orders out. And if I spread my orders out, it means that, okay, if it pops up and just takes my 107.50, so be it. If it comes right down to 107, I think it's still a great trade. I'm going to get a better entry, so I'm going to do it. But I'm still capping my risk. I'm still prepared to take the hit on it. I still know how much that's going to be monetarily, and I'm still happy with that based on what my reward is. Where that is ineffective, where it's dangerous, is where people are just adding blindly under the illusion that they can recover the trade, where they can just go, oh look, if I lower my average price, then it will come back up eventually. And yes, you know what, if you had unlimited pockets, you're probably talking about 99.9999999% of the time, you will get the money back. You look at any chart, very rarely has it completely gone to zero, completely gone to infinity and never come back. Yes, there are times to time if you do that with a stock, maybe the stock will go bankrupt, then you can't get it back. But most of the time, you'll get enough of an oscillation on the way down if you've got deep enough pockets to ride it out. But it gets big quickly, man. It really does. If you're adding, let's say you're adding again, and you're not even doubling up. Most people would consider true martingale to do 10, then you do 10, then you do 20, then you do 40, then you do 80. You can see how big that gets really quickly. It's like a martingale roulette system, isn't it? Where people go in and they start for the pound, they go 2, they go 4, and they keep doing that. And before you know it, that's why there's a table limit. It gets to something silly like 800 quid and there's 60, and then from a £1 bet. And yes, it's unlikely to have a string of X amount of heads or, black or reds in a row, but still, and the market's a little bit different because the oscillations are there, but still, the risk of ruin is there. And why have that risk of ruin? You just get this wrong, you're a little bit early on this, you're adding, and it just spits through the floor, you're in trouble. You're in big, big trouble. So, doubling down to recover a trade. The best way to recover a trade, guys, is to close it when the thesis of the trade is no longer valid. If you're trying to buy a low here and it keeps going, the thesis is wrong. The best way to recover a trade is to ditch the trade that isn't acting the way you want and focus on the next setup. If it's still okay and it's sitting in that no man's land, doesn't need recovering, it's fine, it's still an active trade. There's no recovery if the trade is gone to a level where the thesis of the trade, or the idea, is completely flawed and negated, then it needs dumping and move on. Who cares about one trade? It's about where you are at the end of the quarter, where you are at the end of the year, not about what happens with each trade. So, final thing, guys, you can use this in certain controlled circumstances where you've pre-planned entries, scaling into the position under certain circumstances, parameters, with a risk stop in there, but doing it blindly just because you want to bring down the average and hope that the market will oscillate and push back up is a recipe for disaster, and it will wipe you out. So be careful with that, guys. Be very cautious about this recovery of trade kind of scenario. All right, guys, take care, and I'll see you in the next one. Keep your risk management, whatever you do. Bye-bye.